right, everyone, I think we're going to get started now. My name is Jordan Ford. I'm the Business Operations and Human Resource. Oh, wait, let me make sure this is recording. Perfect. Okay. I'm the Business Operations and Human Resource Manager here with Financial Insights Wealth Management. We provide fiduciary financial services, specialize in wealth management and retirement planning. As many of you know, we do a quarterly Wisdom with Women, and this is a new series we are starting in addition to the Wisdom with Women to bring financial insights and education to our community. Keep your eye out for additional webinars in the future. I am very pleased to announce our speaker, Alan Hensley, CFP. Alan joined our team at Financial Insights last year and brings considerable experience and enthusiasm with his passion for helping others with their financial goals and retirement planning. He enjoys coaching all aspects of your financial journey, from financial literacy 101 to complex retirement plans. Alan will pause between each section to answer questions. You can write your questions in the chat box or ask during those segments. This is recorded and will be available to watch and share in the next few days on our YouTube channel, and we're going to email a link once that's uploaded. Thank you again for attending. We're excited to have you all here. And here is our speaker, Alan.
Thank you, Jordan. And yes, I am excited to be here. This is something I'm very passionate about. Financial literacy is something I could get up on a soapbox and talk about for hours, about how just crucial it is that I think everyone should have the basic understandings of investing and retirement planning. So we have a very ambitious goal today to hopefully just provide a crash course into what investing is and what it means, so that you can leave this conversation and then be able to talk about stocks and bonds and investing from the very basics, maybe to the slightly complex. But I just want to be clear that today's webinar, this meeting, it's not meant to be an all-encompassing course on every aspect of retirement planning. It really is designed for those that are just getting started with investing, or maybe you need a refresher on something that you learned a long, long time ago. So when I say an ambitious agenda, this is what I'm talking about. Thank you, Jordan, for the intro. I am going to talk a little bit more about my financial literacy journey here in just a second. But really, I want to get to the very, very basics of what financial literacy is. So we're going to talk about the lingo. Sometimes it's referred to as the jargon in this industry. What is cash? When we say cash, what are we talking about? Same thing. What is a stock? What is a bond? And then what is a fund? So I'm going to try and define those. That is the what portion of today's meeting. And then I just want to make sure we all have this baseline understanding of why invest. Why are we investing in the first place? And that's where I've got this great chart that talks about the power of compound interest. If that's something you've never heard of before, I think you'll find this really exciting. And again, if compound interest is something that you've been enjoying for many, many years by doing your own investing and saving, I think this will be a helpful visual aid on why you're doing it. And also, if we're going to talk about investing, we need to talk about risk. And I am going to try and just high level make sure that we understand risk is a part of investing. And if you're investing for something that's a short-term goal versus a long-term goal, you need to really understand why you might not want to take risk with something that's short-term, and why it's okay to be aggressive and take more risk with a more long-term goal. And then something I call the retirement plan alphabet, or the alphabet soup sometimes, as I like to refer to it. The 401ks, 403bs, 457s, 401a, there's a ton of these just crazy names. What are they? What do they mean? And more meaningfully, what impact does it have on your investing and retirement planning journey? So we're going to talk about some of the rules, and I think I might demystify some misconceptions that people have around 401ks or IRAs. And then there is, of course, just regular investing. You might have your own investment accounts, and that's what we call in the industry a taxable investment account. Again, I'm going to put that in the same category as lingo or jargon, but a taxable investment account is also a great way to save. Of course, we're going to focus a lot of today's conversation on your employer plans like the 401k, or a personal investment for retirement, an IRA. But let's not forget, if you're just saving on your own, there's other ways to do that. And I completely recognize this entire conversation, it's a lot to take in. Ideally, this is going to take 35, 45 minutes, and I want to save room for question and answers. So within the next hour together, I'm going to throw a ton of information at you, but let's follow up, let's connect. All of my contact information is going to be there at the end. We can meet over Zoom or in person or the phone. So there's lots of ways for us to continue this conversation and definitely make it more personalized for whatever you're trying to save for. So with all that said, before I dive into the meat and potatoes of this talk today, I do like to share my journey, my experience with financial literacy, and then really just drive home why it's so important. And just right up front, financial literacy is super important because when you think about retirement planning, and especially if you joined this webinar today, you might be thinking, all right, I'm going to learn how to invest. I'm going to learn what to do in the stock market. And don't get me wrong, those are very important components to long-term investing and retirement planning. But really, at the end of the day, financial literacy, it should be empowering. It should give you confidence. And if you're taking all the right steps towards short-term and long-term goals, that ultimately you should have peace of mind. I call it the sleep test. If your investments and your financial plan is keeping you up at night, well, then you just need a little education. And obviously, I think that's where we come in. Financial insights can be that guide, can give you that peace of mind. And, that's when I think back, this is going back to my childhood. I like to tell this story. I was 12 years old and my dad was diagnosed with cancer. And long story short, my dad's doing great. He's with us today. So good news is he beat the cancer. But I have this really vivid memory as a 12-year-old overhearing my parents in the other room talking about what is this 401k thing? They were really stressed out. My dad was in the military for a long time, so he had a pension, but this idea of investing in the late 80s, early 90s, it was new to him. And I could sense that it gave a lot of fear and anxiety. And also as a 12-year-old, I said to myself, why are they talking about this 401k thing when we should be dealing with this family crisis? And as I reflect back on how I got to where I am today, it all started there. I bought books on the stock market. I bought books on modern portfolio theory as a 15-year-old, and then going into college, lo and behold, of course, I get a degree in econ and find myself in a financial planning career. And that's what I get fired up about, is trying to hopefully pass on the knowledge that I've earned and then take the stress off of my clients' shoulders. And I call it those light bulb moments. When I see that light bulb pop above somebody's head, because they get it, they understand what we're talking about, that's where the job gets really fun. So that's my journey. I bet everyone has some sort of pain point in their life that revolves around money. And I think if we just go down to the basics, a lot of that stress can be removed with a little bit of financial literacy. So that's what we're going to do today. And like I said, what the heck are we going to talk about? Well, it's those basics. It's the lingo. We're going to talk about stocks. We're going to talk about bonds, and we're going to talk about cash, because you can't talk about money if we don't talk about cash. But when I do say cash, I do want to make sure that we're all on the same page. Cash is the lowest and most times no risk investment. So if we're thinking about risk, which we're going to talk about later, this is all the way at the safest part of that risk scale. This is where you put money into a bank or a credit union, or maybe you've got a high yield savings account online. Typically, cash is going to earn a little bit of interest, not much, and it's there for short-term goals and, most importantly, an emergency fund. So I'm envisioning in the future, I'd love to do a course on how to prioritize your savings. If you've got a little bit of money left over at the end of the month, where should you put it? We'll maybe make that a financial literacy 102 class or something. But when you have a little bit of cash saved up for the rainy day, this is something where you don't want to take any risk with it. That's why it's cash. But I also want to make sure when I say cash, I'm not talking about those $20 bills in your wallet. This is usually cash that you have in a bank account or a credit union. And just quick side note, if you are thinking about how much should I have in my emergency fund, this is a very personal question. It depends on what's happening in your life. But if we're just going to create this rule, I say let's make it at least bare minimum 3 months of expenses. So if you figure out what you spend in a month on your rent or your mortgage, plus all your other bills, plus you got to eat a little bit of food, if we times that by 3, I think that's a really good target for an emergency fund. But cash, for a lot of people, is the foundation of a really good financial plan. And again, this is where I'm already getting a little deep into the weeds on what you should be thinking about, how much cash you should have, where you should put it. But when I say cash, I'm usually talking about the money you've got in your checking and savings account, for example. But let's now shift gears to specifics around investing. And I bet if you've been having dinner with friends or family, or maybe it's Thanksgiving dinner and someone's talking about their stocks or their portfolio, and you're kind of like, oh yeah, all right, they're talking about the stock market, but you don't really know what that means. That's where I want to give a couple of helpful rhymes. I know, again, I'm taking this all the way back to grade school, but if you're taking notes at home, and if you only leave with one little tidbit today, this is what I want everyone to remember. Stocks make you an owner, bonds make you a loaner. So owner versus loaner. If we can understand that concept, then I think the rest of it's going to be cake. So what do I mean by that? Well, if you buy stock in a company, and just I think this might be something you might have heard shares, you might have heard the word equity. Really, we're all talking about stocks. Stock means that you own a piece of a company. Think of the biggest companies that come to mind, or, the smallest companies. If they're publicly traded, that means they're selling their stocks on the stock market, New York, NASDAQ, wherever. That means they want people to invest in the company. And if you own a stock, you really are a part owner in a very, very large corporation. And the whole idea of why you want to buy stocks is you want your investments to grow. I think that goes without saying. And typically, an investment is going to grow over time if a company does well. Again, this isn't rocket science. If you put money into a company, you become an owner in that company. Yeah, we want that company to create profits, to grow and grow and grow over time. But the opposite is true. If that company doesn't do well, typically that means your investment will decline over time. And that's, the ups and the downs of the markets. You can see on this little graph here, it is a roller coaster ride. There's ups in a company's lifespan. And, there's been examples of companies completely going out of business where all of those people that bought those stocks, all of a sudden their investment can go all the way to nothing. So that is important to keep in mind. There is risk. Again, I keep hinting, we're going to talk about that later. And stocks, they typically go on this roller coaster ride that you have to be comfortable with. And again, if you have a lot of conviction in a particular stock or a company, that's usually where you want to buy it. A little side note, I am going to emphasize the importance of diversification here in a second. It's that old saying, don't put all your eggs in one basket. That will definitely applies to investing and buying stocks. So keep that in mind. But remember, here's the rhyme. Stocks make you an owner. Bonds make you a loaner. So owner versus loaner, what's the difference? Well, it really is that simple. If you are looking to invest and you purchase some bonds in your portfolio, that means you're lending money to a company or maybe a government entity. And then over time, the promise is the deal that you make with that company or government is they're going to pay you a little bit of interest for maybe a couple of months, a couple of years, whatever the term is of the bond. And then at the end of that, when the bond matures, you get your money back. So again, I'll reiterate that. Let's say that you really want to put money into some company, but you're like, I don't know if I can trust that they're going to do really, really well. I think they're going to do okay. So maybe I'll buy a bond. And when you buy that bond, really you're giving money to a big corporation. They're going to pay you a stated interest. And then at the end of that, maybe it's a couple of years later, they'll give you back whatever you originally invested. So bonds, they don't typically go on giant roller coaster rides like the stocks do. But there is this idea that if you own a bond and you decide to sell it, well, before it matures, that's totally fine. That's your bond. You can do that. There's this concept of, well, that bond has a market value. And if a company's doing really, really well, that means they have a really high or strong credit rating. Their credit's good. Think of it that way for your own personal credit. So it's pretty easy to sell a bond at a giant corporation that's doing well because they typically have a high credit rating. Well, the opposite could be true. If a company is in distress, they're not doing well, and it's like, oh, geez, I don't know if they're going to be able to pay that interest or pay that bond back. Then their credit rating goes down, then it becomes more difficult to sell. And you usually have to sell that bond to a different investor at a discount. In other words, you can lose money. And this is really important when you're buying bonds in corporations. The whims of the profits and the margins and everything that goes into what makes a corporation's balance sheet look good or bad can affect the value of the bond. It's a little bit different with government entities, especially if we're talking about the US government. Those are the safest bonds out there. So now I can't say the word guaranteed, but it's the closest thing you can think of when we're talking about bonds for the US government. But yeah, this concept of investing in stocks and bonds, owner versus loaner, This is where typically, this is not always the case, but you can kind of think of the stocks as the offense and the bonds as the defense. That's one way to really just, I think, very high level conceptualize why you have a mix of stocks and bonds in your portfolio. Over time, when the stock market's going up and the economy is doing really well, you want to participate in that growth, and the stocks are going to allow you to do that. And then the bonds, they're chugging along, they're doing okay, they're going to pay some interest over time. It's good to have that mix in the portfolio. Now, figuring out that right balance, should most of your portfolio be in stocks? Should most of it be in bonds? Or what's the balance that you need to have? That depends on a lot of different factors. How long can you stay invested? In other words, are we talking about retirement that's 30 years away? Or are you retiring yesterday? And we need to figure out and be a little bit more defensive. Now, just to be clear, again, I think this would be good for a future conversation. We can make the case to be 100% in either of these, but a lot of times finding a mix of the two, depending on where you're at with your financial goals, long or short term, that's going to be a conversation that we can have and personalize what that mix is. All right, so last part in this section that I want to talk about, and then I do want to check to see if there's any questions that came up. When I say stocks and when I say bonds, typically that means we're going to make a recommendation for you to invest in a fund, a mutual fund, or maybe an exchange traded fund. I think the idea of investing in stocks and bonds really is quite convenient when we think about putting money into a fund. So remember earlier I said diversification is really important. And I probably will sound like a broken record by the end of this, but I can't emphasize enough that you don't want to have unneeded risk in your portfolio. You don't want to put all of your eggs in one basket. So that's where a mutual fund or an exchange traded fund can do a lot of that diversification for you. So a fund, really, all it does is pool together stocks, bonds, and cash all into one financial instrument. So, for example, you could buy one mutual fund that buys the entire US stock market, and there's funds that buy the global market. You can also target funds that go for large companies or small companies, international sector funds. So the list, or what I sometimes call the menu of available options in the world of mutual funds and ETFs, it's huge. And a lot of times it can be overwhelming, but that's where at least you have the tools available to invest in the stock market. And for example, if you wanted to buy the S&P 500, which is a very common index that's usually referred to in the news when they're talking about the stock market. It's the 500 largest companies here in the US. If you wanted to invest in that, you could painstakingly go and buy 500 different stocks and then manage those. Or you could buy a mutual fund or an ETF that does all of that for you. So I think in terms of convenience, diversification, and then these funds are becoming lower and lower cost every single year, it seems like. So efficiently, this is a really good way to build a portfolio so that you are invested in stocks and bonds and cash, but all in kind of a one-stop shopping way. All right, that's the first section. I know, a ton of info right out of the gate. Let me pause. I'll check in with my team to see if there's any questions. I don't know if Jordan's available to see if anything that came up, but yeah, let me just take a quick look. All right, so we had a question come in around, I think risk tolerance is a good way to kind of phrase this question. And this is where, yes, you have to be comfortable taking a little bit of risk, and we're going to talk about that why in this section right here. But I think also the way to conceptualize risk and maybe find comfort in taking risk is to just have a really good understanding of the long term. And when I say long term, we're talking years and years and years or decades and decades out into the future. We're going to look at some historical references here in a second. But I do want to caution anytime that you're looking at historical data or performance or just, what has the market done over the last 10, 20, 100 years? Historical information is very valuable. It can kind of show you what has happened before, but also it can be dangerous. And what I mean by that is, imagine you're driving down the freeway at 60 miles an hour. You've got that rear view mirror right there, just a little bit up to the right. And it's a good idea to take a peek in that. It shows you what's happening behind you, where you've come from. But you'd never want to only stare at that rear view mirror. That's the same way you should approach historical information. It's good, take a look, understand what's happened, but keep your eyes on the prize. Keep looking forward, knowing that if you are saving and investing for a long-term goal, you're going to go through ups, you're going to go through downs. And then if you have confidence in the US economy and the world economy and the stock market over long periods of time, that's hopefully going to help you stomach that ride a little bit. But trust me, I get it. Stock market crashes or corrections or downturns, whatever you want to call it, it's never fun to go through those in the moment. And zooming out and finding that long-term perspective can be challenging. Hopefully, after today's class, you'll have a little bit more confidence in that. I think that's it. Jordan, did I miss anything else? Just a quick check-in on questions.
No, I think you answered both of them with, yeah, that was
Yeah.
it. Any other questions?
And also, we'll go through this. Hopefully, it gives everyone some good information, but we are going to save some time at the end too. So if I didn't answer it, definitely let's revisit any of these ideas. But let's shift. I think at least, hopefully, everyone on this call has a good understanding of what we can invest in: stocks, bonds, cash. To be clear, though, there's a million other investment ideas out there. We're just kind of talking about the core portfolio principles of investing. I get it. This is a very high level course, but let's talk about why. Why invest in the first place? What are you doing it for? And a lot of times I do like to start the conversation with new clients of, why are you here today? Why are you thinking about investing? And why do you want to invest in the first place? If we can get that question answered first, then we can dive into the mechanics of what we need to invest in. But let's look at this chart here, which, trust me, there's a lot going on. I'm going to break this down, hopefully, so that we can all understand it together. But let's talk about compound interest. So there's a famous quote by Einstein. He said that compound interest is the eighth wonder of the world. I'm a little biased, but I tend to agree with him that it is pretty exciting to see your money grow and then grow faster and faster and faster over time. But like we just looked at, there's different types of ways to invest. And each of these, historically speaking, have performed differently. And that's where this chart is supposed to provide some historical reference to what happens if you invest in the stock market or bonds, or what if you did the under the mattress model and you just kept all your cash and you never invested it. So when we look at this chart, we're going back a little over about 100 years ago. So we're going back to 1926. And we're looking at what if, hypothetically speaking, you invested $1 into these different types of investments. And I think this is a really helpful chart because it breaks it down, not just stocks or bonds, but we're talking about small company stocks, large company stocks, and then government bonds. And then inflation down here at the bottom. Think of inflation as kind of the cash type of investment. So if you put the money in the bank and you just left it there and it paid a little tiny bit of interest over time, what would that look like fast forward about 100 years later, or about, let's see, 26 to 2023 is what this chart goes to. So let's start at the beginning. If you just kept money invested in cash and you saw what happened over time, and if we just tied the cash performance to inflation, which is about 3% over this really long time period, that dollar would have grown to about $17. So cool, it went up. That's great. But right out of the gate, I think it's pretty obvious to see if you put that into the stock market, we're talking about huge multiples compared to what you would have got in the cash. So I think if we look at the starting value and the ending value, it's really easy to tell the story. Oh, okay, yeah, you should definitely invest in the stock market because that went up the most. But let's pump the brakes on that idea a little bit and let's look at the ride that these investors went on. If we rewind the clock all the way back to the Great Depression, 1929, the huge stock market crash, the stocks, they took a huge dive and it took them years to climb out of that hole. And if we just look at this bottom line down here, a lot happened over the last 100+ years. It talks about the space race, JFK assassination, the stock market crash of the 80s. Let's not forget that there's been crashes in recent history too. The 80s, if we think back to the tech wreck or the internet bubble of the early 2000s, and then hopefully everyone on this call is at least familiar with and maybe remembers what happened in 2008, 2009 during the Great Recession. going through these market crashes, in hindsight, it all sounds theoretical and maybe academic, which that is today's presentation. I get it. But again, try to have some personal memories of going through a downturn in the market. It's not fun. It's stressful. It can change the way you think. Again, I hope that everyone at least is thinking long term, but in the moment of a stock market downturn, it can be very stressful. And if we just zoomed in on one of these, it can be really detrimental to a plan, but then zoom out again and you can see the recovery. Maybe it took a year or a couple of years in very severe cases to get back to even, and then the growth continued. So this is where I think it's important to understand, yes, over long periods of time, stocks have outperformed, but they've also gone on a much more volatile ride, and that's the word that we use a lot in this industry is volatility. And that's just, the ups and the downs, their bigger peaks and bigger valleys in the market can make the road a lot bumpier. But again, with the long term in mind, I have a lot of confidence personally, and I think most of my colleagues do, that over the next 100 years, the US economy, the world economy will find ways to grow. But this is also where it makes sense to have some balance, depending on where you're at in your career or where you're at in achieving your financial goals. You've got to make sure that you've got that good mix of stocks and bonds, cash in the portfolio. And again, finding that right mix, it's going to be a little bit different for everybody. But I think this should paint the picture of why the heck are we investing in the first place? Well, number one, we want to outpace inflation. So that's something that for a long time, the last 15 years, inflation wasn't a big deal, but the last couple of years, we notice it at the gas pump or the grocery store, or if we're just going on vacation, everything costs more. So what we call that is the purchasing power of money. Inflation is kind of that invisible risk that, again, if you got all your money in the bank, you're not going to see it go down per se, but how much you can buy with that dollar is going to decline over time because of inflation. So we want to invest in outpace inflation, but also we want to invest so that our nest egg grows, that we have more in retirement to rely on to generate our own income. And I think this is a very, very long view of what can happen over time. I get it. This is probably longer than you're thinking, but I think this is also really illustrative of why it's important to stay invested. All right, so I've hinted at it enough. Let me just dive right into it. Investing involves risk. There's no question about it. Unless we're talking about cash at the bank, there's going to be risk. There's going to be ups and downs in market performance with stocks and bonds, mutual funds and ETFs. They're all going to go through a period that stings and hurts. But the whole idea is, and I think this chart slightly oversimplifies things, but if you think about risk, why take more risk? It's so that you have more potential for return. So if you're investing your money into something that's low risk, there's a lower return potential. And if you're investing in something that's high risk, there's a higher return potential. And this is where, if we go and think about the chart that we just looked at before, if you have a long period of time before you need to access whatever you're saving for, so again, if we're thinking about retirement in 15, 20, 30 years, you can take more risk. You can be more aggressive, knowing that over long periods of time that you should get potentially a higher return if you take a higher risk. And again, I am emphasizing the word potential. There's no guarantees with any of this, but that's really the whole idea of investing. If you've got to put money into an investment and you know that you're going to need it in a few years, then if you look at this line right here, you probably want to be closer to a low risk, also potential low return thing, so that you know that whatever you're putting your money into, you can have access to it in a few years, probably at the same amount or a little bit more. That's the idea of taking a low risk, low return, and the opposite. If you've got a long time frame, you're probably going to be in this kind of upper right-hand quadrant of this chart here, higher risk, potential for higher return. I know this is completely oversimplifying the risk tolerance conversation, but when we look at a financial plan and when I build out a portfolio recommendation for someone, this is what's happening in the back of my mind. And there's spreadsheets, there's a lot of data that can back up, how someone should invest, how much risk someone should take. But really, I'm going to go back to something I said earlier. If you're invested in something that's keeping you up at night, even though the math and all the spreadsheets says that you should be, well, then we need to go back lower on the scale. So hopefully through education and a financial literacy class like this, you can understand why it's important to take risk. But also at the end of the day, there is that what we call behavioral component to investing. And if your investments are giving you more stress, then we need to either dial back the risk or just do a little bit of education. But it's that combo deal. So this is hopefully answering some questions that were asked in that last break. But before I jump into the next section of how do we invest in the first place, let me check in. Jordan, any other questions come through?
No questions as of right now, but if anyone has questions, please raise your hand or go ahead and put it in the chat. We'll give you about a minute to ask away.
The last thing I will say about this section, so while you're thinking about, right now we are at a pretty unique period because inflation is so high. Inflation just a couple of years ago or less than a year ago, it was in the 8-9% range. So we're at a very unique time where inflation's higher than the long-term average, which means that if you do have cash in your emergency fund, this is a good time to make sure you're taking full advantage of the higher interest rates on savings accounts or CDs. These rates are projected to maybe go down later this year or next year. So it might be short-lived, but this is definitely one of those periods where with inflation so high, there is a silver lining. Not a great time to go out and get a mortgage, but a really good time to put your money into something that's earning 3, 4, 5% guaranteed. And that's something I don't get to say very often. So
And it looks like we had a comment about maybe a course on how to read or understand the Raymond James website for one of these financial insights
yeah,
sessions down the road. So great idea.
I love that idea. Yeah. And, financial literacy from a macro point of view, that's what we're talking about today. But yeah, just the logistics, the ins and outs of how to navigate the Raymond James website. That is a great idea. Thank you for sharing that. Okay. So this section is where the rubber meets the road. We've talked about what are stocks, what are bonds, what's cash, talked about risk, different return potential for different investments over time. But let's actually talk about the nuts and the bolts of how you can invest, how you can put your money into the market for the short term or the long term. I will preface, there are a ton of different ways to invest. I completely understand that. For today's webinar, I am going to talk about some of the most commonly used investment type vehicles or accounts, but just know that there are a million other ways that we can invest. And that's something where I'm happy to connect with offline and we can talk about kind of your personal options. But if you're sitting at home right now asking, Alan, I'm ready to invest. How do I do it? Well, for a lot of people on the call today, I think an employer retirement account will be the main way that most of us save throughout our careers. So if you're still in school right now and you're watching this webinar, you probably don't have an employer retirement account available to you, but you will someday. And this is just, if we take a historical perspective on how 401ks and 403bs and 457s really became mainstream, they've been around for a little over 40 years. And there was this shift in the early 80s where previous generations would work at a company and money would go into a pension. And then when you retired from that company, well, you kept getting money, almost like a paycheck. That's called a pension. You just got that your retirement years. Well, in the early 80s, things changed where all of a sudden employers started phasing out pensions and phasing in these retirement savings accounts where the employee had a lot of responsibility to make sure that they were saving for retirement. Now, again, this is another one of those soapbox moments. Maybe I'll have another class, another course on this, on the history of how the 401k was introduced. I'll just say that the introduction of the 401k didn't go as smoothly as everyone had hoped. In recent years, there's been a lot of legislation and changes to how these are introduced to new employees. But at the time, a lot of people were like, wait, I have to take money out of my paycheck to put it into an investment? What is that all about? Thankfully, fast forward 40 years to 2024, and I hopefully assume a lot of people are putting money into their 401k, and there's even something called an employer match where an employer can put money into a 401k on behalf of an employee. So we've come a long way over the last 40 years, but still the responsibility of saving enough and saving the right way, most of that does fall on your shoulders for your career. So this is just the one slide I have on 401ks today, because a lot of times people don't realize how much they can put into their 401k. And I keep saying 401k, and I understand if, if you work for the state or if you're a teacher, or you might have a 403b or a 401a or a 457. I'm just going to use these interchangeably today. But just know that if you are under the age of 50, you can put $23,000 a year into a 401k. And I'm just going to pause there. It's a big number. And a lot of times people think that, okay, I got a new job and the employer is going to match 4%. So I'm going to put in 4% because that's the max. I'm here to tell you that the max is probably a lot more than you realize. $23,000 is the calendar year limit of how much you can put in. And this is for 2024. It goes up every year. And if you're turning 50 this year, or if you're already over the age of 50, you can do another $7,500. So that's $30,500 that can go into a 401k in 1 year. Huge number. The other misconception or maybe misunderstanding that I run into a lot is people think, okay, yeah, $23,000, I'm going to put in this much and the employer's going to put in that much, and that should get me to 23,000. Well, I'll tell you, the employer match, the amount that your employer puts in for you, that does not count against that $23,000 number. At the bottom of the screen here, you'll see that limit per participant and how much can go into a plan. That number is $69,000. So if you're putting in up to 23,000, we'll just know that a lot more can go into the plan from employer or after tax contributions. Side note, we can save that for a future webinar as well. But I'm here to tell you that if you're saving in your 401k, it might be very likely that you're not hitting the actual maximum amount that you can put in there. So I understand too, that is a really big number. So if you've got your first job out of school and you're starting to save, it's hard to put $23,000 a year into a 401k, but create a goal, create a path, because the sooner you can get to that max, well, then as your income continues to grow, you'll get to kind of see how fast your investments are growing as well. So this is, again, specifically around employer retirement accounts. So this is something you get through your job, through your work. 401k is the most common. Just know there's a really high ceiling on how much you can put into these plans. Now, the other way to save for retirement, if you don't have this option available to you at work, or maybe you're looking for additional ways to save for retirement, these are IRAs. So an individual retirement account has a totally different set of rules. So I want to just keep it high level today, but just understand the contribution limit, how much you can put into an IRA each year. It's a lot lower than a 401k. So again, if you have your 401k available to you at work, just know you can pedal to the metal in terms of savings there. If you're saving in an IRA, you can see the limit there. If you're under the age of 50, $7,000 is the most you can put into an IRA. If you're 50 or older, you can put another $1,000, so 8,000 total can go into an IRA. But the real conundrum is IRAs have these weird income limitations. In other words, if you make too much money, then you're not able to directly contribute to an IRA, which it sounds counterintuitive. Trust me, I think it's crazy too that there are these limits on, if your income is so high, you can't put money into these accounts. But just realize that's the reality of it. And I am going to talk about the difference between a Roth and a traditional IRA here in a second. But as we stay on this topic here, you can see if you're Roth, if you'd like to put money into a Roth IRA, and if you're filing your taxes as a single person, and if your income is greater than $161,000, then unfortunately you can't directly contribute to a Roth IRA. And those limits are different for traditional IRAs, again, depending on how you file your taxes, single or married filing jointly. There are these crazy rules on if your income goes above a certain threshold, you're unable to directly contribute. But again, that's where the beauty of the 401k comes in. There's a lot of room there. There's a lot of ways to save. And then the last thing I'll say around the 401k and the IRA, just a little tip at home, you'll see that all of these rules have this 50 plus. Again, that's what they call the catch up. You can put more money into an IRA. You can put more money into a 401k. Just know that if your birthday is at the end of the year, again, let's say that you're 49 right now, but you're going to turn 50 later this year, you can contribute more in the calendar year, technically before you're 50, as long as you're going to be 50 by the end of the year. I know that's a little thing and a very specific tip for those that are on the call today, but just know that if you're getting close to 50, you don't actually have to wait until your birthday to do that. You can do it in the calendar year in which you turn 50. All right, let's keep going with this because I've brought up the idea of what is a traditional IRA versus a Roth IRA. And also, we're seeing this more and more. It's very common to have a 401k that is a Roth available to you at work. So I'm going to use a lot of jargon today, but just know that traditional means pre-tax. So this is the same if you're putting money into a 401k or you're putting money into an IRA. Pre-tax means that it's going in before taxes. And then Roth post-tax, Roth 401k, Roth IRA, this is going in after taxes. And I've got a really easy way for everyone to remember the difference and the tax impact that these different types of accounts have. So if we all put on our farmer hat here just for a second, this is going to be the best way to remember how these work. So when we think about why put money into a traditional versus a Roth, really what we're asking is what are the tax differences between a traditional and a Roth? How is my money taxed differently if it's pre-tax traditional or if it's Roth post-tax? Well, imagine that you're a farmer and you are presented a choice. As a farmer, you have to pay taxes. There's no way around it. And the government says, okay, you can pay taxes later, and then we're going to take a portion of your crop. So a traditional IRA is also called a tax-deferred retirement account, which means that you're going to pay taxes in the future. In other words, you save a little bit of money now because you don't have to pay taxes on whatever you contribute to that traditional pre-tax 401k or IRA. So it's great. You save a little bit of money now, but just know that over time, ideally, your investments are going to grow and grow and grow. And then later, when you need to tap into that account, then the IRS, then the government taxes some of that. So imagine you're a farmer, you plant everything and it grows, and then it becomes this huge field, and then a portion of that crop needs to go to the IRS for taxes. So if you're putting money into a traditional 401k or IRA, you're taxed on the crop. The Roth works the complete opposite. So again, that same scenario, you're a farmer, you've got this handful of seeds and you're going to go plant your fields. Well, if you put money into a Roth IRA or a Roth 401k, then you have to pay a little bit of the seeds. You give a little section of whatever seeds you've got over to the IRS, and then you get to plant everything and it grows and grows and grows, and it's all yours. So you're paying taxes now so that all the growth that you experience over time is tax-free. So again, traditional means you're taxed on the crop. Roth means that you're taxed on the seed. If you're not a farmer, hopefully this analogy still works. I was thinking about bringing in my big farmer hat, but I didn't do that. Next time I will. But this is also where after I teach anyone about traditional and Roth, everyone asks, all right, Alan, which is the best one? Pre-tax or post-tax? And my answer is always yes. That's my only joke in Financial Literacy 101, I promise. But it really depends. It depends on your income now. It depends on your income later. There's a lot of different variables that go into figuring out which one of these options is best for you. Sometimes that might be a combination of both. So that's the last thing I'll say on deciding traditional versus Roth. There's nothing saying that you can't do a little bit of both or half and half or 60-40, whatever that mix is. Again, that's a great time for us to connect offline and I can kind of go through that thought process with you on which option is going to make the most sense right now. All right, so this, I think, entire conversation has been focused really on retirement planning, but I do want to talk about taxable accounts. And this is one where you might have your own brokerage account that you do your own investing in. Maybe you put a little bit of money into an account that's not an IRA, that's not a 401k, and that you're just kind of taxed along the way. It's important to understand how that taxation works in these types of accounts. So if we're thinking about putting money into an investment, a stock or a bond or a mutual fund or an ETF that's outside the world of retirement accounts, it's just a regular account. The timing of when you buy and then sell that investment, that's what impacts the taxes. So on the top here, we have this concept, and this is another piece of jargon that you might have heard before, but capital gains. It's just a really fancy way of saying, hey, did your investment grow over time? And whatever that growth is, those are capital gains. And if those gains are realized after a year, So let's say you buy something today and then you sell it a year from now, or a year and a day from now. That is what we call a long-term capital gain. And those are taxed differently. So if we just look down here, depending on if you're married filing jointly or if you're filing your taxes as a single person, depending on what your income is for the year, you might pay 0% capital gains tax on a long-term gain. And you can see it can go up to 15 or 20%. Again, all depends on your income bracket. But this is, maybe advantageous for something that you've got a shorter term goal on, or you don't want to put money into a retirement account because retirement's still 20, 30 years away, but maybe you're saving for something in 5 or 10 years. This would be an account to consider. But just to finish that thought process on capital gains taxes, if you buy something today, you invest in something, and then you sell it in a week or a month or 6 months from now, if it's less than a year, then that's considered a short-term gain. And short-term gains are just taxed like your regular income. So again, if we look over to the federal income tax brackets here on the right, married, filing jointly, single, depending on what income tax bracket you're in, you're going to pay that on those short-term gains. So again, pros and cons to each, but I did want to at least bring up the idea of investing in these different ways. And then last slide, I debated on putting in this or not, but if we're going to talk about and think about saving in 401ks or IRAs, again, retirement specific accounts, there is this idea of a required minimum distribution, a lot of times abbreviated RMD. Just know that if you put money into a traditional, so that's the pre-tax version of retirement accounts, that you are required at some point later in life to take that money out. Now, why do you have to take it out? It's so that the government can tax those distributions. And depending on when you were born, that might be age 73 or it might be age 75 for you. But just know that if you're saving and saving for years and decades, that your IRAs could get very, very large, and these required distributions in your 70s might jump you up into a whole nother tax bracket. So it's important to keep in mind there are these ages that you have to remember. The required minimum distribution ages start in the 70s. And then the last thing I'll say about IRAs and 401ks is that if you need to take a withdrawal before age 59 and a half, it's most likely going to come with a 10% penalty on that distribution. So again, you're very much encouraged to keep this money in there until at least your 60s. Now, if you have to take it out, there are hardship reasons that you can take money out without the penalty. Again, that's really getting into the weeds, but just understand that the whole point is to try and save this money for a long, long time, at least until you're 59 and a half. All right. Looking at the clock, we're approaching the hour mark. That was a ton of info. Again, thank you for bearing with us on the technical difficulties at the beginning. But if any of these ideas resonated, or if you want to dig into this more with your own personal plan, let's connect. My email's there, my phone number's there. And then, of course, if you go to the alan-hensley.com, you can sign up and find a spot on my calendar for a Zoom or an in-person meeting. So with all that said, I think we got it all in there. Jordan, any additional questions come through while I was talking there?
As of now, not yet, but if you guys have questions, please ask away.
Well, again, I encourage everyone, if you have a question, put it in the chat box there. But the last thing that I'll talk about is that concept of IRAs, traditional versus Roth. The only thing that I didn't talk about today is Roth conversions. This is moving money from a traditional IRA to a Roth IRA. I am not going to get into the details of how it works, but I just want to make sure everyone knows it's possible. You can do it. There are tax implications. But if you're at this stage of life where you've got a huge traditional IRA, but you don't have a lot in Roth, and you're thinking, well, shoot, I wish I did more into Roth, let's connect. Let's definitely talk. This is an idea that takes careful planning, but the end result can be really beneficial.
Perfect.
All right. Well, I don't see any questions coming in, so please reach out if you think of something later. Let's connect. I don't know, Jordan, any closing words from you?
No, thank you so much. I really enjoyed the topic and really read all the information. So thanks so much, Alan. And thank you everyone for attending. Really appreciate you, and look for our next Wisdom with Women and our next Financial Insights.